another weekly stream. If you guys have any questions, bring them right down below in the comments. We're going to talk real estate, we're going to talk the stock market, we're going to talk my predictions for interest rates, inflation, and more, and give you basically a weekly update on what's been going on in my life. So what's been happening? So today we had a little bit of a downward pressure, but in the last week, things have rallied for the NASDAQ. The top 100 tech companies, AI, NVIDIA, crushing. We last talked last Wednesday, so I think the price action was like in the 330s. It got up into the 350s on the QQQ for the NASDAQ, which was phenomenally overpriced in my opinion. Still is a bit overpriced, but it's impossible for us to predict a top. So it's really hard to try and do that. I think it's probably not a wise decision to try and pick the top, but at the end of the day, the smartest thing we can do as investors is take all the data, all the inputs, and try to work from there. So let's look back, right, and think about what's been happening. So the Toronto, I've been talking, to be short, for the last like 6 months with a long-term bullish focus, right? In the long term, we are always bullish on real estate, on stocks. In general, we want things to go up because they do. And so to try to be bearish over the long term is extremely dangerous. Over the short term, it can be very smart. It can be a good hedging tool. It can be a good performance driver in recessions if you have a short position to protect your long positions. And I really think that right now we're in an interesting time. We're in an AI bubble, first off. Hey guys, welcome on. Everyone's just getting the notification now. Welcome to the live stream. Mike, how you doing? Martin, how you doing? David, how you doing? Welcome to see you guys on. I'm happy to have you. So lots of things have been going on. If you look at the Toronto Stock Exchange, in the last month, it's down like 6%. If you look at the Dow, it's down like 5%. In the last 6 months, it's down even more. If you adjust the S&P 500 and also adjust the NASDAQ for the AI-focused bubble names, like you remove NVIDIA, and I guess even Google and Microsoft and Apple are really just like using keyword Apple AI in all of their announcements, and people are just going hype over it. I think it's a little bit too hyped. And we're seeing the price to revenue, price to earnings ratio similar to what we saw in the dot-com bubble. So almost the exact same. And if you historically track, anyone who buys companies that are, you know, at like a 200 plus PE ratio, which is where NVIDIA sits right now, or at more than 10 times annual sales, they have historically performed 50% worse than the S&P 500. So the data tells us this is probably a dangerous game to be longing these names that are potentially overvalued. Now, don't get me wrong, I love NVIDIA. I'm a gamer, so like I've loved NVIDIA's, you know, graphics card systems, my laptops and desktops for years. I've loved, you know, their hardware. I come as a miner as well, as a graphics card miner, so I love NVIDIA cards. They're fantastic, but they are trading at values that don't make sense. They have to grow by like 40 to 70% for the next 6 years in a row and assume no competitor tries to take them on in any way in the specialized graphics hardware space. That's a lot of things that have to happen. And people are like, oh, but like they only have to grow another 300% and it's all good. It's like, wait, so you're gonna pay for a company at future values because it may hit said targets? And it might, by the way. And I think that someday NVIDIA will be worth $400 a share the way it's currently going. But is it currently worth that now? Looking at today's discounted cash flows, using discount rates at current interest rates, at potentially 6 months from now interest rates. And a lot of people are using low rates, assuming that things are going to fall and assuming inflation is going back to 2% really soon and that rates are going back to 2% really soon. And they might, but not soon. In the midterm, probably. In the short term, I don't know. I think that the next Fed meeting, I think it's June 13th or 14th, the FOMC meeting, they're going to give us another hike. There's a good probability we're getting more rate hikes to come. And Canada may follow suit, actually, with some of the bad inflation data we've seen out of Canada here. Inflation is actually sticky, showing that it's kind of trending a little bit up. In the US on last Friday, the market rallied, the S&P rallied, the NASDAQ rallied, everything rallied because the debt ceiling is maybe come to a resolution. We don't know. They're going to vote on it tonight around this time. But there's a lot of things that could come up between now and then. But who cares? Like, everyone knew. It's not like anyone expected the US to default. They're not going to default. All they have to do is they have so many different measures. They can just print money to solve their issues. So that's not, we never expected the US to default on their own debt. They're going to kick that can down the road as long as they humanly can. We probably have at least another generation before there's a Roman era type collapse of that current fiat system. Maybe longer, who knows? But it's obviously not good when for prolonged years, decades, you spend a lot more than you earn. And so the way to solve that is to stop spending or to increase earnings. And the way they increase earnings is by driving GDP higher, by having their citizens be more productive through technology and AI and advancements in productivity. All of that helps. People going back to work after COVID, all that helps. But then you have to tax the shit out of that revenue base. So, and that drives productivity away. And that drives the drivers of the economy out of the economy. And so to expect that, like to make the balanced budget, they really need to tax more. And that's a challenge that they're battling with. And I am anti-tax. I am pro, selective giving. So if you have I want to have the option to choose where the funds go and how they're allocated, so it doesn't get wasted and go to government bureaucracy. So I would love to see a program like that, but that'll never come. They would like to decide how we spend our money, not us decide who. Not the payers of the tax decide, but the people. So the people who don't contribute anything should have the vote to decide. That's democracy. But anyway, okay, I'm gonna go into the Q&A for a second here. I see the hellos. Jeff TLT, I don't follow that stock at all. In a Business says hello from Kitchener. Hey, how you doing? Welcome to the stream. Mike says, you may have answered this in the past, but very quickly, how can you profit on a neutral option strategy if it doesn't give up your short loss, equal your wins, your buy? So, okay, so the way you would profit from running like a zero DTE delta SPX delta strategy, which means like zero means you're not long, so it'd be a positive number if you were long your portfolio, it'd be a negative number if you were short the market. I'm currently short the market about minus 400 SPX, which is not that short for the size of my portfolio. Every dollar it drops, I lose $400. But the way you'd profit from that is you would sell and you would collect theta decay. So you'd collect the time value of these insurance contracts. So you could set up spreads. You could sell, bear call spreads with a capped loss. So that would mean you would sell a call and then you would buy a call way out of the money and create a spread there. So the reason you'd buy the call too at the same time as you sell the one deeper in the money is because now you're short the market, but you have a stop out. So if you're wrong, your loss is defined and it doesn't affect your margin near as much. And so you collect a premium on that. The difference between these two would be a credit. So you get a credit spread. And so that would be your short position. And over time, even if the market trades completely flat or it bounces around and ends up in the exact same position 2 months later, if you're holding the shares, you'd make nothing because, it's just back to where it came from. Less dividends, of course. But if you did an options contract doing the exact same thing, simulating the exact same movement, you collect time decay because a lot can happen from now to then. So you pay for the potential of what can happen. And so if nothing happens, then you collect a premium for that. So there's a time value on that. And the other side, you would sell a bull put spread, which would be the same thing as I just described with the calls. However, you would just buy a put. You'd sell the put and then buy a put really, really far out, like for a few pennies a contract. And that would protect on the other side if it ran against you. And over time, you could collect decay. Now, I'm a degenerate, and when I like to invest in stocks, I do play that strategy, but I sometimes get in these ego moments where I feel like I know better than the market and that all the data seems to disagree with the market and the market isn't efficient. The market isn't efficient, but let's pretend the market is efficient, the market is right. Sometimes you do things like I did where you short the market 5-1. And I shorted the biggest NASDAQ rip 5-1 in the last few weeks. It's been so painful. I hope that there's a top in, and I will continue to keep my short thesis until I see any indication that I might be wrong. I continue to risk manage though a lot harder than I was. I was just holding the position. That was stupid. What I should have been doing is like each day wiping the position clean, taking the loss, starting fresh each day, and rolling the contracts with 0 DTE, 0 days to expiry. That's the way to do it. So if you're going to collect data decay on these contracts, basically, and then when you sell an option, you agree in the future to take said shares from someone, and you get paid a premium for that. So if you agree 2 months from now to be assigned shares at $100, you will get you'll get $2 a contract. So you're really getting effectively $100 minus the $2 premium they're giving you, the insurance premium, because options are just insurance on the underlying stock. So you can buy insurance, and it can be a defined, like if you buy a put or you buy a call, you're hoping it goes way up. So in the future, you can call for those shares. And if you're buying a put, you hope that it goes down, so you can call to have those shares put into someone else's account at that strike price. So really what you're doing there is you're paying a premium. So if you go and you're the seller of options, someone's buying options from you, you're getting a premium for that right of insurance. And so it's just a game where like over the year, you should get around a 10% to 12% yield. So it's nothing really fancy, but it is a cash flow generating strategy, and it can be done at delta neutral, meaning you're not long or short, and regardless of how the market moves, you make money. It is a strategy that can be applied. In practice, though, it's very difficult to not be long or short and to not let ego get in the way. You've got to really watch and manage your positions to run a strategy like that. But yes, in theory, you can use insurance on your stock portfolio. The way options should be probably used is you should have your indexes, your ETFs of underlying, positions that you love, and then buy a little bit of protection by like selling covered calls on those positions, or maybe buying some really cheap puts in case a black swan event happens. There's a book on that. I think it's called The Black Swan, that talks about having that insurance all the time on your portfolio might cost you 1 or 2% drag on the overall yield of your portfolio. But once in a while during recessions or when black swan events happen, those contracts pay out 10, 20, 30 to 1, and you use that to buy more of the companies you already like in your portfolio. And over time, it's been shown to actually outperform just holding equities by themselves with no insurance. So options are a great strategy. They're more intermediate and advanced strategy, but when applied to the right portfolio can be fantastic. If you don't understand options, there are ETFs that will do it for you. There are ETFs you can use to buy with currency risk adjusted for you. So if you're wanting to buy US equities and have exposure to the US market without being exposed to the US Canadian currency fluctuations, like in the example, in the last year, I think the Canadian dollar's lost 9% to the US dollar. So if you held some US companies and you're up 10%, the currency drag on that is 9% loss. So you'd be screwed, right? In that weakness. That's what's going to happen with the currency fluctuation. So anyway, okay, there you go. Jeff says TLT is US 20-year treasury bonds. Collect 3% until Fed flip, then ride the wave up. There you go. So there are plays with bonds too, where if you don't believe that the Fed is going to flip in this summer and you think they're going to flip later, there are some interesting bond plays you could make where you can make some really, really good money. Because remember, bonds get destroyed. As rates get higher, the current bonds get destroyed because no one wants a bond with a coupon of 5% when market is paying, say, 8%, right? So it gets really hard to sell the bond you have. And if you have a 10-year bond at 5 and the market's paying 8, I just made these numbers up, then you've got a 3% spread between market rate and your coupon on your bond. Over 10 years, if it's 8 and you're getting 5, that's a 3% loss over 10 years. It's a 30% drop in the face value of that bond, right? Because you're going to lose 3% differential over the next 10 years. So some of these bonds get crazy. This is how the banking collapse happened, right? Is that these banks had really safe treasury bills at 2% because the Fed went out on TV, on the internet, and their specific message was lever up, take our debt. We're going to print lots of money. We're going to keep rates low for a long time. There's lots of clips of the Bank of Canada, the Fed saying the same thing. Rates are not coming up. We're coming out of COVID. We're going to keep rates low for the foreseeable future for many years. And inflation is going to be fine. And they were wrong, obviously. But anyone who loaded up like the banks did, they parked a lot of money in these vehicles. And when there's a lack of liquidity, people are pulling their money out of the banks. Well, what happens is they'd have to then go liquidate those treasury bills or those bonds that they have parked their capital in. And you can't. Even treasury bills take massive losses on a 10-year if the differential is even 2%. 2% on a 10-year is a 20% wipe. Losing 20% of deposits might be the entire liquidity that you have. So then you got a real problem where you have banks collapsing and the FDIC insurance coming in and basically government bailing out effectively through the FDIC, bailing out all these banks, right? And the equity holders get screwed on the banks, but that is how it works. And there may be more pain yet to come. We potentially aren't out of the woods yet. Okay, hey Paul, how you doing? So Mike says, I bought AMD at 139, sold 22, March 3rd, 85, now it's back 139. Oh man, that sucks. I'm sorry to hear that you had those drops. I did some of the same things. So like I went on here and I told you guys in November, December that I really loved Intel. I loved Meta was my top holding. I had like $800,000 in shares of Meta at $90 a share. Meta's like what? It got to like 240, 250 a share. It's like almost a triple. And I fucking sold it in January. I got like a 15% rip and I was like, oh, I'm good. And I sold it. Oh, it's hard. It's hard to hold that bag until the time comes to make the maximum profit. And I told everyone who asked me, was like, do I sell my Meta shares? I'm like, nah, just hold on to them. And then I went and sold mine. So do as I as I say, not as I do. It's very hard to hold on. It is. It's hard to time the market. It's why, in general, I like to focus on, and I'm trying to get away from trading and try to get more passive, so I can put my active time into things that have good dollars per hour. I can go make $500 to $1,000 an hour in real estate, and I can't. It's very hard to make $500 to $1,000 an hour in the stock trading world. Some of the best traders in the world, you know, they don't beat the market consistently. So it's very hard to have an alpha or an edge in that space, and I can't pretend to say that I do. I The more I learn, the more I realize that my competitors in that space are so much smarter and better than me, and have the best tech and the best teams, the smartest people. Whereas in real estate, people are super dumb. There's a lot of mom and pops that are just retarded, and they own properties in cash, and they have no idea about leverage, and they don't know how to optimize. Some of them, I see hotels and buildings for sale where like their way of generating revenue to find tenants is like a newspaper ad. It's like they have no technology in their business. And so there's so many, each property is its own business. Each building is its own business. You go there and buy these businesses that are run so poorly, run them better, and then sell them. And that's a way to make insane return, where in the public efficient markets, you can't. It's really hard in the same way to make that same sort of yield. So for that reason, and just for stress, like, man, the stress, guys, when I have days where I'm losing, it's so stressful. Whereas in real estate, it's different. It takes a long time for price action to happen. So like if real estate falls, it takes a long time. You have many, many, many days before prices fall. And we don't have an accurate reading on prices day by day, minute by minute, right? It takes months for us to see the data of how housing is unfolding. So you have a lot of time to react. And because real estate isn't very liquid, people aren't just like panic selling. It takes months to sell a property from start to finish. If it's a big building, you might have to market, you have to prepare it for sale. It takes a month. Then you gotta get photos and listing, get it all on the market. It might sell on the market for a month or two. Then you're gonna have a 60-day closing. So you're like 5 months just to liquidate that property, which is a good thing in many ways because people can't panic sell. They have time. And by the time they list it, they think about like, you know what? This building's generating me cash flow. It's a good building. I'm just gonna keep it. I don't need to panic sell it. And so you don't get as much of the panicking that you do in the stock world because there isn't an efficient market to trade in it. It's a lot of arbitrage opportunity for us to get in there in an imperfect world and buy businesses. And I think real estate is just businesses, but it's a really safe. The thing I like about real estate is it's super safe. You buy a company, you lose 4 staff, the company's worthless. You could buy a company of 10 staff. If you lose 4 key staff after you purchase the business, you might be fucked. Like you might lose everything. But you buy a property and the property manager quits or a contractor quits, you can plug and play. There's 20 other property managers who will do just as good of a job. And your customer pays you rent every month, no matter what. There's a wait list of customers that want to buy your inventory of units that are for rent, especially if you make them somewhat nice and you keep up the building. It's like the customers just come. It's like guaranteed contracts. It's like buying a business with guaranteed government contracts. The revenue comes in no matter what. That's what I love about real estate, is that you have that guaranteed revenue. All you have to do is manage the expenses well and try to do some improvements to improve the building overall. And if you do, and if you build it, they will come. There's a housing crisis. So we have so many tenants who are looking for places to live. That's a business that I'm bullish on. And then on top of that, you have this natural appreciation. These buildings and this land over time is appreciating. And the buildings are, cost of supplies like lumber and concrete and, copper and the wires and the plumbing. All of that is appreciating like crazy with inflation. And because you can lever up real estate 5 to 1 really easily, some people lever it more. Because you can lever up real estate 5 to 1, you get a huge lift. You can lever up at, say, a 5 or 6% cost of debt. And then if your building's generating 10% yield, then every dollar you borrow, you make a huge spread on, and you live on that spread. And that's just, it's a safe, consistent business that is at scale, a fantastic way to build wealth. And if you treat it as a business, it will produce in ways that I think a stock portfolio can't. A stock portfolio is more passive, and if you don't options trade every day, then it isn't near as bad. I just happen to have gambler tendencies, and I can't help myself but to trade. And I'll be adjusting my positions and thinking I'm smarter in the market. And ego is one of my challenges, where ego maybe helps me in the real estate space, give me the confidence to go in and negotiate with a person who has a 15-unit building and might get me a better price, right? I might be able to use that ego and that confidence to get in there and make changes to the building and improve the business model. Whereas in the stock world, they're just different businesses. And it's very hard, I think, to compete in the stock world against some of the quant funds and some of the smartest PhDs in the world and some of the best teams when you're sitting there with a laptop in your living room. You don't have that edge, right? So to develop that edge is something I don't want to do. You could develop an edge, but it's just not something that I have interest in. So. Martin says, no longer have employment income, living off of rental income. Interesting. Congratulations. That would mean you're, I guess, financially independent if you're producing enough income to live. Any benefit from incorporating to assist in getting further financing from B lenders and small commercial financing? So the nice thing about when you don't have a job anymore, if you're buying commercial real estate, so sixplex or bigger, the building qualifies for the financing, not you. And so it doesn't matter what you're doing personally. You don't even need a job to qualify. You could be a full-time real estate investor, and as long as you can show the bank that you have a track record of performance of managing units and doing a good job, then they'll back you and they'll loan based on the building. So that's pretty cool. That's what I love. One of the things I love about commercial financing. But I'm trying to think of any benefits. Like from a tax perspective, I guess if this is your full-time thing and you had a team and you were like flipping buildings and stuff, that'd be an active business. Flipping is actually considered active automatically by the CRA, so it qualifies for the 12% tax credit, which is cool. Yeah, so if you don't even need more than 5 full-time employees, if you're doing a flipping business, it's automatically active in nature. Now, as far as structure optimized, bigger buildings, you have to buy in corporations. Most of the banks don't want to finance them personally, and why would you want to? So if you're buying medium and bigger sized buildings, when I think about that, I'm thinking in a corporation it's better, it's cleaner, less liability risk, and then you can choose what to do with that income. You're going to be taxed in the same way. Rental income is considered, passive income, so they're going to tax you pretty actively on that. The high tax rate in Canada on that. From a tax planning perspective, you can flow income out of your corp to your personal if you need to do that. I would say larger stuff in a corporation is standard. I don't see anyone buy larger buildings personally. It's very rare, but yeah. Would you incorporate for a flip? Yes, 100% I would incorporate for a flip. There is zero reason to flip in your personal name. Don't do it. The banks don't like it. The CRA doesn't like it. Flip inside of a corporation. And you get to defer taxes at that corporation at a 12% tax rate until you decide at some point to take that income out. And if you're taking out a small amount, you can take it out tax-free up to $30,000 a year per spouse. So definitely flip inside of a corp. There are huge advantages to flipping. Flipping is a very attractive way to earn an income because you can defer that inside of a corporation. So I have a very large flipping business inside my corp, and I'm so glad that I do. Personally, I don't do any flips. I keep all my long-term, like my cottage and my house and stuff in my personal name, but everything else I go do inside my corps these days. What's your 3-year real estate prediction for Ontario based on current data with immigration? So there's some bullish factors and some bearish factors when it comes to my current forecasts for real estate. I would say long term, I'm very bearish. So 5 years out, I'm bullish. 3 years out, I'm bullish. 1 year out, like this winter, I'm bearish. So I am bearish on real estate in the short term. We've seen a bit of a rip, almost 10% rip up in price. That is a seasonally normal thing. If you look at the last 20 years of data, 30 years of data, December, January is typically a low, and then the May is typically the upper 8 to 10% difference between the two. So you want to sell in the spring, you want to buy in the slowdown of December. No one's buying. On top of that, properties don't look as good. There's snow and slush and sleet, and the landscaping's bad, and it's cold, and there's problems when it's cold. Just in general, properties don't look as good. And then on top of that, agents are on holiday. People are not focused because it's around Christmas. They're just not focused on buying. So in the residential housing sector, you'll see a bit of a dip around the holidays where not as much volume's happening. There's a lot more variance. And so I think that if you're going to pick a bottom, it's going to be around like December. Some people say that the bottom already happened in Ontario, that we already had that this past November, December into January. It definitely was a trough. Do I think it's the bottom? I don't know. Could we test that bottom again? Potentially. Do we go lower? I don't know. Ontario took a pretty big beating, and I think it's shown now with rates being a little bit higher. Although, like in Ontario rates, you can get a 5-year fixed rate in the 4% right now. So rates are not that high right now. The bond yields have fallen considerably in Canada. The market is cooling down as far as like the the yields that mortgage lenders are expecting. In the fall, there was fear and no one was funding anything. Banks were saying no, lenders were like, no, we're just afraid. So there was just not a lot of liquidity. Now there's liquidity. Lenders are trying to get loans funded. And so that extra liquidity is helping things with the spring heat that we're seeing. So prices are actually up almost 10%. We're seeing most cities in Ontario, London included, Kitchener, Cambridge, Hamilton, GTA, all around Ontario, we're seeing more than double-digit price appreciation in a few-month period. Which, like, if you have $1 million house, that means you just made $100,000 per house. It's $1 million. If you have a $1 million building, you probably just made 10% on your investment. And if you put 20% down, that means you just made 50% on your down payment. So a 10% rip in appreciation is significant. Let's not pretend that's not significant. I am disposed, so I'll tell you what I'm doing. I'm selling 2 more properties into this spring heat. They're flips that I bought last year. So one of them is a triplex that I've had for a long time. There's reasons why I'm selling it. So if you're interested in a triplex in East London, hit me up. It'll be in the probably 700s. It's a really nice duplex. It's got an ADU in the back, so it's got 3 units in total. Beautiful, beautiful property. Hit me up if you're interested in that. It is a really nice, could be a really nice owner occupiy with some cash flow. It's rare to find those coach houses or those ADU self-contained units. It's got a really, really big lot. But I'm selling some of my assets off, and not because that's a bad property by any means. It's just that it doesn't fit my parameters of what I'm trying to do. And I like to keep my capital continuing, recycling, growing. And long-term buy and holds are just not something I'm interested in Ontario. So I don't do long-term buy and holds. I will do some Airbnb stuff. London doesn't like Airbnb all that much. They're not very friendly for that. But in general, I'm doing a little bit of cottage rentals, but I'm trying to get to more of a flipping model. And that's because I believe that you make a higher yield, continuing to churn your real estate. Once it's stabilized at a 5 cap rate, dispose of it, buy 2 more at a 10 or 12 cap rate. So that's just the business that I'm in. But what do my forecasts look like? So I think Bank of Canada is going to have to hike more, and that's going to shock the market. So I think we're getting another 25 basis point at some point this year. The other option, the more safe option that the Bank of Canada could decide to follow, the path they could decide, is they could decide to just keep rates higher for longer. And I think some people are at the point of almost breaking where rates are at. And if we go another 6 months or 8 months, I think by the winter, we're going to start seeing some pain and some liquidation, and there just won't be the demand to pick that up. On the other side of those macro factors, driving things down, we also have a really difficult building environment, and it's hard to add units. The municipalities are not really allowing for a lot of inventory. That said, Bill 23 is helping that in Ontario. We're getting more inventory. They're making it so that you can add additional units without getting zoning approval and site plan approvals, which is making things easier. So that will add some units to help with the immigration problem. And it's not really a problem. It's a good thing for Canada, but we're taking in record number of immigrations each year. I think over 500,000 people. So our population is growing by immigration like 2-3% a year compounded, which means that Canada's going to double with birth rates and everything else. We're going to probably double in over 20 years, which is insane to see a 25-year doubling of the population of a country. That's significant. And I think that definitely has some ramifications for real estate. It's going to make land more valuable. As you bring more people into the country, they all want a place to live, to call their own, and they all have a desire to buy. And I think that that's going to drive things. So it's a really, really bullish factor. Also, if Canada was under better management, Canada has a lot of really great natural resources, a very smart, healthy population, a lot of good things going for it. So on one hand, I think that there are some short-term bearish factors for Ontario and for Canada, and we may see a bit of a pullback, but I don't think we're going to see a major crash like we saw. Like what happened in, I guess we'll call it like March of last year to the fall, like where we saw almost 30% drop in some places. We aren't going to see that amount of catastrophe again, I don't think. I mean, anything's possible, but there's a very, very small probability of that happening compared to, say, the more base case situation, which is probably pretty flat for the next little bit until rates have substantially fallen. Next question. Sorry, guys. Mike's starting to build up inventory. Home's not selling now. Market just flipped in a few weeks. I can't wait to buy. Interesting. So I've been looking really at the data, but I look at like the monthly report that comes out, and I was seeing that there's, some record sales again that we hadn't seen since like June of last year. We were making a lot of the recovery back that we lost into the fall. I think it's short-lived. I think, it's the fluctuation of coming up, but it's still got a little bit more down to go. I don't know. I don't know for sure, but how much more? Maybe 10%. I don't think we have a huge amount of pain to come. So when you're running your numbers, just say, hey, what would be the worst case scenario? Well, I might have to hold this property for another couple of years until things are again, boom, to new highs. And inflation is still running too, which is a good thing for us. Inflation is going to carry the price of these assets further. Great explanation on panic selling on real estate. That's why it's more stable. It is true. It is more stable. Commercial real estate is interesting too right now, as some of these notes renew, and they're like 3-4 cap rate buildings, and you've got like 5% notes. Well, now you can't carry a building when the cap rate is lower than the cost of borrowing. And so if rates stay high for long, and people are forced to renew their mortgages for a 3-year period during these high rates right now, they're in pain. Even if rates come down, they're locked in for 3 or 5 years. And so it can be major pain. And when looking at that, people might say, wow, I can't afford to do this for another 5 years. And so they'll just decide to sell the building off. And in a lot of cases, a lot of these building owners have had these buildings for a long time. So they'll just sell it. They don't care if it drops 10%, 20%. They bought it at 50% ago. So they're still making a profit. So there is potentially, like, you could see a contraction because of how much growth we saw in such a short period of time. Real estate in Ontario just went like almost parabolic. Like, we saw insane growth. And so we could see some pullback. There is a bear case scenario where we see a 20 or 25% further pullback. But again, I think the base case scenario is probably down 10% or flat from where we are now. Into next spring, I think we'll see more heat. But into this winter, I think there'll be a 10% pullback from where we are now. So if you're buying in these highs right now, maybe wait. Maybe. I just bought 2 properties in Sarnia area, but they were off market and they were well priced. But I haven't bought anything recently on the MLS. Next question, can you go into a little bit of detail about how OPM financing works? So Anna, you gotta be really, really careful with OPM. All these gurus tout, how great OPM is, using other people's money to do deals. And the challenge with that is that when you borrow that money as debt, which is if you're good at what you do and you're a good operator and you know how to flip or you know how to renovate well, you know how to manage costs, if you're a good operator, you can buy properties and you can add a lot of value to them. You want to always raise the money as debt if you're not a good operator or you're not generating a really, really good yield. And I think they are different. Being a good operator and generating a good yield are not the same. You can be have a really great operation that runs really smoothly, but run out of 5 cap. All your buildings are 5 cap. And so you have a smooth, super awesome operation. It's super impressive, but you're not generating a good yield on your capital. That happens a lot in the large multifamily space. But if you're generating a good yield and you're good at what you do, and the bar I use to decide if you're a good investor is not how smooth your operation is. It's the yield that you're getting on your equity, on your capital that's invested in that business and in those properties. And if you're good at that, you can churn that capital and get a high yield, then you should borrow debt at 10, 12%. You can make a great return on that. Go to first mortgage at 5 to 7, get a second mortgage if you need to, and that's using other people's money. So that you would come and get a mortgage for 80% loan to value or 75% loan to value in first position. Instead of getting the 20 or 25% down payment, other people's money would be you call up a private lender and say, hey, would you put a second mortgage on this? Here's my business plan. I want to renovate this property and do X, Y, and Z. Will you fund it? And they'll put a second mortgage on the property and you'll pay them a fixed return. Often it's 12, 15%, whatever for that second mortgage. And you're in a deal 0 down. There are specifically flipping lenders who do this type of product, but you need to have good experience to get it. You need to do the first couple of deals before they usually take a chance on you. It's definitely something that I think will, over the long term, I think there is definitely some opportunity. I saw someone post those at AI. Mention AI and home prices will skyrocket. I like that, stick man. Yeah, really, like how can AI make things easier? Really, AI could actually do a lot in the real estate space. It could lease your units for you, post ads. You could make copy for listing agents. It can do photos, photo editing. There's a ton it can do to revolutionize the industry and make things more efficient for sure. But it's a tool. Like AI isn't sentient, it isn't its own thing. You as a real estate investor have to bring that into your business so it can write copy for your ads for you if you get someone to teleprompt and command it to do so. It's just a tool. It's a cool tool, which can make things more efficient. Where we're using VAs at $6 an hour, now we can use ChatGPT. Does it really make the business that much more efficient? It maybe adds 10, 20% to the margins, maybe, because ChatGPT can do things that the $5 an hour VA can't. In more established businesses that don't use as many VAs. Maybe it'll replace the $20 an hour secretary. Is it replacing the CEO? I don't know. Is it replacing, some of the more high key value roles? Is it replacing the maintenance guy that's going to the properties? No. Like, is it really changing the business drastically? Not yet, I don't think. But could it? Potentially. I mean, the technology is getting there so that we can use it as a tool to help us deliver more. And so in that way, it's great. I like AI and I like where it's going. I think that there's a lot of hype and that some of these companies like NVIDIA are overvalued. I have a small short on NVIDIA, but I don't have the balls to short that right now. I'm shorting the NASDAQ, which is, enough. It's enough of a gamble for me. It's more of a hedge, I guess. So in Victoria, BC, we are seeing the slowest number of starts in 12 months in the industry, 12 years in the industry. Victoria never slows. I hope it isn't a sign of worse things to come. So what you're seeing right now is that labor costs are high because inflation is high. So everyone wants to be paid more. No one wants to work for less. So you got your costs rising. And then the biggest cost for developers, builders is the cost of debt. When you're developing a project, you have a huge mortgage on it. And you probably have short-term financing, and you've got loans, small construction loans, and things like that float at Prime Plus. And Prime's almost 7%. So you got Prime Plus, maybe 7, 8, 9%. That when it was 2%, you could build something for a lot less. So it's really expensive to build. Then at the same time, prices have fallen. So the sale price that the builder is getting is dropping. And at the same time, the costs to operate their business are rising. And so margins are getting squeezed, which is why projects are not being built. The thing is, people are still moving there. We're getting tons of immigration, tons of people, immigrating, and population's booming. So you can't, this won't happen for long. What will happen is probably the prices will rise and that margin will be there. And the prices will rise because they're not building enough. So then basic supply demand economics is if you continue to have more demand because people are moving into the area and you're not building more supply because it's not profitable to build it, what's going to happen? It's going to be a shortage, and it's going to push the price of those properties up until there's enough margin the builders fill that gap. But right now there is going to be a good bit of lag that will create an opportunity for us. And that's why I'm bullish on real estate in the medium to long term. Again, short term, there's still more pain to come. Developers will fold, builders will fold. People will wonder who can't, they have large multifamily portfolios and they can't service them. There are 3 or 4 cap rate properties, big buildings or whatever, in Toronto, Vancouver, even London, you've got buildings that are 4 cap. Those buildings don't make any sense with a 6% commercial loan against them. They don't make sense if the cost of the interest on your mortgage is higher than the cap rate or what the asset is returning. Every dollar you borrow creates a net negative spread. It needs to be the opposite way around. The reason we had 4 cap rates that worked is because you could borrow at 2% interest. So you had a large spread. It was your asset at 4% cap rate was generating twice what the cost of the debt was. Now it's an inverse. Cap rates have to fall. So short term, there is pain. Either rates fall or cap rates fall. And I don't think we can afford to let rates fall yet. The Bank of Canada can't do it. Inflation's sticky. We need to get inflation down. And so rock and a hard place for the next little bit. It's going to create a really cool boom, though. Coming out of this cycle, we're going to have a lack of inventory. No one's going to have built enough units. And we have, as long as they continue to immigrate 500,000 people and potentially even 1 million new immigrants a year, that's substantial. When you have 1 to 3% of the population growing just by immigration alone every single year, that's going to create a supply-demand imbalance. And so I am bullish for the long term. That helps. Yeah, right. Opportunity is coming around the corner. That's a good point. Good point. Do you think the real estate market will ever have a real bad crash? DW, it did have a real bad crash. In Ontario, we saw a 30%, from peak to trough, a 30% drop. A third of the value of some properties, like in Oshawa and some of the tertiary markets, we saw a third of the value gone. So houses at the peak were selling for $1 million, started selling for $700,000. That was substantial. Like, to go from $1 million sale price to $300,000, if you bought with 20% down, you lost everything. Your entire $200,000 down payment's gone. And if you tried to sell today or tomorrow, I guess at that time, you would have had to give the bank $100,000 plus 5% closing costs, which is $50,000. You'd be at $150,000. Your entire $200,000 down payment on the house is gone, plus $150,000 to walk away. And in Canada, we have recourse mortgages in Ontario specifically. So it was a really rough situation, short term for some people, probably got cleaned out a little bit. Yeah, so that's my thought on that. Which province do you think has the most upside appreciation? To be honest with you, probably Ontario has the most upside. And the reason I say that from an appreciation perspective, not from a cash flow perspective. The reason I say that is because immigrants come and want to live where other immigrants are. And we have some mecca immigrant centers in Ontario. People want to be, if you're from India and you want to move here, you want to be with other people who are from India, your family, your friends. You want that culture. And same from China, wherever. Like Vancouver has a really great Chinese Asian hub. So they will continue to attract like-minded people. And so what happens is those areas, I think Vancouver will appreciate well also. It's a beautiful place. I think it will do really well. But Ontario, Toronto, as an example, will do really, really well because, again, they're getting a large percentage of the immigrants. And Quebec's kind of, they want only French-speaking immigrants. So, I mean, we're getting that supply-demand imbalance, which will push appreciation. On top of that, it's easy to build out west and out east. It's a lot easier, a lot less red tape. And landlording there is a lot easier. There's no rent controls out there, which isn't good for appreciation. Rent controlled areas skyrocket because what you have is this, when you try to force things to happen, when you make it so that no one can build, it's really restrictive to build new units, then the old units become very in demand. And so that's what's happening in Ontario. And I think because we don't build enough here, we're going to have an imbalance that will push appreciation faster. And there's more demand here and less supply. So that's going to create a kindling for a nice bull run fire into next spring and then the spring after that. I think 2024 into 2025 is going to be very, very fruitful. But again, we don't know if any other new factors could come into play that change everything. Based on what we currently have, the current data, it's a really nice setup for a good bull run in the real estate market coming. But no, I wouldn't buy right now unless it's a really good deal. If you can wait, if you're going to buy at market, wait until the fall or the winter. Again, that said, I'm still buying stuff. And if the right deal comes along that's priced 3 years ago with enough margin that I can afford a 10 or 20% pullback, I'm going to buy it, right? So, I mean, there's always deals all the time if you know where to look. Schneck says, hey, Mike, great seeing you at that multifamily event on Sunday. Yeah, I did come out on Sunday to that. It was fun. I saw Grant Cardone live. The question was, how are you structuring portfolio? Is it trust, holdco? So currently, I just literally have it set up as corporations. And said corporations, I have an active corporation that does active flipping. It's an active business. It buys the properties. And I have another corporation that is more of a passive holding corporation. I have another corporation that's a lending corporation. And I have a stock thing as well. So that's my structure. The 3-tier structure is kind of dead now. There's no real advantage other than from a liability perspective to setting up these 3-tiered structures. They used to be really complex structures that made a lot of sense. They don't have any real benefit now. I will eventually, hopefully, if things come together as I think they will, I will migrate. You guys have seen the videos on this where I talked about migrate to the Bahamas. 90 days a year, I have to spend 90 days in the Bahamas. That's my new primary residence, my new tax residence. And then I will still be able to come to Canada and the United States and run businesses there, but I will operate from the Bahamas. And because there's no capital gains tax, no income tax, nothing, a 1% corporate tax. So it's really a favorable place to do business in other countries. And from the Bahamas, you can 1031 exchange in the US as well, with the Bahamas corporate structure that would own like a Florida LLC or a Texas LLC or whatever. That's advantageous to be able to 1031 exchange. I thought that was a US citizen right. It's not. Alien tax residents can 1031 exchange. Just that Canada doesn't let us do it. So as long as you're a Canadian trying to 1031 exchange, not going to happen. So you got to get rid of the Canadian tax residency. You can keep your passport and you can always just come back. If you've got cancer or something, just come move back to Canada on free healthcare. You start paying tax in Canada again. I mean, for me, probably it'd be cheaper to get private healthcare and better quality healthcare than coming back to Canada. I mean, I'd rather pay. The tax savings would be larger than the cost of treating cancer, probably. I don't even know why I said cancer, knock on wood. Like, that's a horrible thing to have. But anyway, thank you for the question. I haven't looked into Calgary's grant on square footage, so I don't know. That seems smart. I think generally we're going to see a reduction in office space and retail space. People are working from home. They're selling things online. We don't need as much office space. There's too much of it. So I think it makes sense because there's less demand for it, we will convert a lot of commercial stuff to residential to solve for housing demand. So that's a good use of buildings. I'm pro that legislation. That sounds great. Sounds like a fruitful opportunity potentially to someone who wants to go in there and convert some industrial building or some commercial building that's not being used or it's vacant. Because again, the vacancy rates are very high in the commercial space. And if you're good at finding tenants, you can make so much money in the commercial space. If you can land like your Canadian Tires or your Shoppers or your big grocery stores, that kind of stuff, your Walmarts, if you can land that tenant, then your building goes up substantially. But you may go years sometimes with vacancy, and the commercial space is difficult because again, there's only so many tenants. There's a lot of square footage competing for those tenants. So yeah, I think some of that square footage will get used for residential. That'd be a good use of the space. And when grants can make it profitable for developers and real estate investors to go in there and do that, then they incentivize the thing that they want, which is more housing. And so that's a really smart government policy. Alberta runs itself the way that Canada should run itself. Unfortunately, Canada's under bad management federally. What do you think about funds? Again, I don't know. I don't want to shit talk any funds. Everyone has their own thing. Someday I may have my own fund. I think in general, just go deep on the fund and understand how they lever, because you need to understand on their properties the first and second mortgages that exist. The debts come before you do, so making sure you understand whenever you're joint venture partnering or in equity investing that you come last on the totem pole of who gets paid. I did an Instagram story on this to explain how that works, but basically you get paid last. And so it's important as an equity investor to know that you're taking the most amount of risk. And if there's a 10% pullback in appreciation, the mortgage holders don't feel a thing. It all comes out of the equity. So if you're the equity investor and your capital's there unsecured as equity, you have the lowest amount of protection. And so you should try to go for the highest amount of yield that you can, because you're at the most amount of risk. So risk-adjusted return is important. These funds are interesting though, because you can sometimes structure them as capital gains as opposed to interest income. Lending, if you invest at 14% lending, 50% of it's tax if it's a passive income investment. If you could make a whole business around it, it was an active lending business, maybe that'd be a different story. But if you're just like doing a one-off mortgage here and there, that's a passive investment. And you're looking at 54%, 55% tax. So on a 14% yield, your net yield is like 6% after tax. Now, if on the equity side, capital gains are only maxed at 25% tax. Let's say 25% tax for simple math. 25% tax on, say you get a 15% yield in the equity space. Well, now you're only losing 25% of that. Let's say you got 20% on the equity space, because some of these guys are able to deliver a 20% equity yield, right? And, if you're only losing, 25% of that, well, now you got a 15% net after tax yield, which way outperforms a debt interest return of like 6 point something after tax. So the tax perspective can make equity investing really attractive. But if you could protect that investment with some security, that's even better. But yeah, there's lots of funds out there. Whether they're all good operators, you have to do a lot of due diligence into that. And whether they are properly levered, again, you have to be very careful. If they're over levered, it's very dangerous to be the equity investor in that situation. So look to make sure they're good operations, look to make sure that they are properly levering, just do a lot of due diligence, see the types of deals that it's a lot different being an equity investor in a single family house versus being in commercial real estate. There's just so many different flavors of funds. So look into them and see what works best for you. And at the end of the day, it can be very, very tax efficient way to grow your net worth over time. And it's super passive too, which is great. If you're looking to retire, looking to have more time with your family, it can be a very, very good way to park capital and to have it grow over time in a way that will outperform publicly traded REITs, because there's less overhead cost and less compliance. And in general, that leads to more profit for the small guy. So I like them over as opposed to REITs, but just, spread it around. Don't put it all in one thing, and make sure you do your due diligence, make sure you're working with a good operator. Yes, all 3 units are vacant. So the whole property is vacant, comes with no tenants. I can have property management in place and I can place the tenants for the property. If you're interested in that, send me an email at rosehartcapital@gmail.com. Yeah, it comes completely vacant. So you can place tenants and get top market rents. You can pick your tenants. I have 2 property managers I can recommend. I can use the lady that I use most often. She can come with the property. So it is fully turnkey. You can place your own tenants if you'd like, ready to go, freshly renovated, all good. So when I sell a property, I like to leave it with no headaches. Like everything done with a building permit on this property will be clean as a whistle. So yes, this is going to be a good one. It will probably sell fairly easily, and fingers crossed. I'm going to be selling it for about 100,000 less than I would have got last spring, but it is what it is. That's the current market. It's going to be good property. Yeah, thank you so much everyone for watching. I think we're through all the questions. What do I say at the end of every stream, guys? It's time to do the end of the catchphrase. The secret to unlocking your wealth, right? What do you got to do, guys, to build wealth, to grow it? What's the secret equation to financial freedom? 3 things: spend less, earn more, and maximize returns in the difference. Those 3 levers. All you can do if you want to improve your financial future is to find ways to, in your business and in your personal life, spend less, find strategies to crank revenue up to earn more, and then, of course, what you do with the difference between what you're earning and what you're spending is your profit or your savings rate. You take that and you invest that, and you want it to grow as much as possible. And as that fund gets bigger, you want to maximize the returns on that, and it becomes, over time, in the beginning, it's important how you spend, how you earn, but at the end of the day, when you start building a real portfolio up, the return means everything. At my stage in the game, a 1% difference in the return of my portfolio in the year means more than my entire annual spending budget personally. So how I manage my portfolio becomes increasingly important. And as you build net worth, that 3rd lever becomes super important. So we talk about ways to get a higher yield on our portfolios. And one of the ways to do that is by risk adjusting. And that means don't put everything all in one basket. It means embracing a little bit of stock portfolio, embracing a little bit of real estate, buying businesses, looking at different opportunities, doing some lending, a little bit of everything, right? And unless you have that competitive advantage and you're like the badass in real estate, and probably all your money could go mostly into real estate and you'd be all right because you're delivering extraordinary risk-adjusted returns in that business. All right, everyone. See you next week.